All right. Well, thank you, Suzanne. I appreciate the opportunity to talk to everybody this morning. And I'd like to thank, again, Suzanne as well as NFIB for the opportunity today to talk to you a little bit about buying and selling businesses, what I call key considerations for what we're doing and what we're about to do if you are, in fact, going through this process. So I'm going to sort of short-circuit my talk today. If you do have questions on the line as I'm presenting to you, please don't hesitate to get them to Suzanne. We'll do our best to incorporate them into my talk today. If at the end I've reached my limit and you haven't heard what you wanted to hear, don't hesitate to email me. My email address is on the last slide, as well as my telephone number. Feel free to use either or both at your convenience. So I'll get right into it. Again, the way I have this set up is sort of top I don't know, the top 10 or top 8 considerations when you're buying or selling your business. The first one I think is probably the most important, and that's really to get prepared and get yourself organized. And that comes, that's a sort of a broad statement that comes in a lot of nooks and crannies, but unless you are a seasoned attorney that's done, or a seasoned entrepreneur that's done a lot of these, you probably cannot do this yourself. At least if you do it yourself, you may be leaving dollars on the table. So I would suggest and offer to you to get yourself an attorney that knows your business, also a CPA that knows your business, hopefully is working with you already, because as the deal matriculates and you go through the process, knowing your industry, knowing your business itself will come in handy. Also within your company, you probably will need help within the company. Most of the time, the people that you're helping with are your CFO, your controller. You'll need HR help as well for your employee base. You may need some operations people as well to become engaged in this process. That's particularly the case on the sell side if you are a seller. One of the things I tell people that haven't gone through this before, the first time I meet with them, is you really need to understand the whole process of what that looks like from beginning to end. And I've been involved in sales of companies that have taken a couple of hours to some that have taken a couple of years. Each one is a little bit different. Hopefully yours is more like the former rather than the latter, if it's something you want to have done quickly. But it also takes a lot of planning if you want to do it right. So one of the things that Suzanne says, how soon do you get started on this? I typically tell people 3 years is a good barometer for how long it's going to take you to kind of begin the sale process and end it. Certainly it can go a lot quicker than that, but to the extent you need to do some shuffling and some changes within your organization, that's probably a good time barometer. But one of the other things you should do when you sit down with your attorney, if you haven't gone through this before, is get familiar with some of the documents that you want to see from you. And your attorney can give you a list of what those documents might look like. They're probably going to be your financial statements you have in place with either vendors or suppliers, perhaps some employees. But you should be ready for that. One of the other things I recommend to sellers is that they perform what's called a UC, searching commercial liens that are in place against them or their companies. You should always know what liens are out there on you. If you end up selling your company, selling either the assets or the stock of the company, typically a buyer they're going to do their own searches. So you should know what's there so there's no surprises. I can't tell you how often I'm involved in a transaction with a finance situation where we find things that liens that haven't been cleared. Even though the obligation has been paid off, the lien itself is still out there.
Buying a business, that's kind of a critical factor too.
Absolutely, absolutely. Yeah, and if you're buying a business, that's one of the first liabilities that are out there that are attached to the assets that you're trying to buy. And of course, most buyers will want those liens because they're going to want those assets free and clear of any lien, particularly if they're going to finance the acquisition itself or themselves. So one of the things you should do, again, is find out exactly what liens are out there, and if there's anything that needs to get done later.
And can you do that online pretty cheaply, or does that require hiring someone to do a UCC search?
You can access probably a little bit better records than the normal person can, but in Pennsylvania you can go right on the Department of State website and look and be able to track what UCCs are out there. And if there's anything there that looks out of whack, pull a copy of it. There'll be contact information right on that UCC. You can contact the person listed on that to find out exactly, why this is still there. The problem that you oftentimes run into is with banks. There's been so many mergers the last 10 years or so. If you've got an old lien out there by a bank that's been merged out of existence or merged into this bank or that bank, it's sometimes difficult to find someone to help you. Your attorney can certainly help you, go through that process, but it can be cumbersome depending on how old it is. One of the other things you should think about is whether or not you have key contracts that you want to, a 3-year period. You might want to take care of business before that in that window. So you've got a couple of years to take care of something. Maybe you've got a contract with a key supplier that's on a yearly renewal basis. Maybe you want to consider locking that up for a period of time so that when a buyer comes in, you don't have to deal with possible disruption in supply chain. Same thing with your key employees. We also think, well, key employee for you, but is it going to be a key employer for the next buyer or the next owner of this business? They may well be the same, deputy that they are for you, but there again, it's going to depend on who you're going to be selling to. If you're going to sell to, say, a strategic buyer, someone that already maybe has in place a financial backbone, bendable to them. So it's going to take a little bit of thinking through, but in any regard, you should look and think, are there key contracts out there, suppliers, vendors out there that I need to be concerned with as well? One of the other things when you're looking at those type of contracts, and that's a key consideration for any buyer coming in looking at your contracts, and the general rule in Pennsylvania is unless there's a provision that says that it's non-assignable, it's assignable. So that's a starting point, but there are a number of exceptions to that general rule, particularly when you come to employee-based. One of the other things you should do in this sort of get out of the deal, if you're a seller, in this case we're talking about the seller, whether you want to be involved in the business after the sale, do you want to be an employee, a part-time employee, a full-time employee for a period of time? Do you want to be a consultant? Do you want to be involved at all, or do you just want to go sit on a beach somewhere?
That sounds good to me.
Yeah, it sounds pretty good right now in the middle of August, right? But young enough to do other things too. Everyone is different, and understand that you may not get what you want. Also, one of the things to think about is your estate planning. Oftentimes, this is a great opportunity to incorporate your estate plan into the sale as well. Are there other people involved in your family that want to become either part owner, or are we just creating trust for them for the future? It's a really great time to look at your estate sale. And really, the other thing is you should know what your bottom line is. If you're going into a situation where you think, and the valuation just doesn't come out that point where you're only going to be able to net maybe half of that for that $1 million, if it's not going to happen. You're just going to become disappointed, frustrated, and no one's going to be happy.
Bottom line is do you have to pay to have someone come in and analyze it, or how do you do that?
That's a great question, and you should know what the value of your business is to you before you try to go sell it. So you should have an idea what you would like independent. Look at your financials, but also look at your intellectual property, which is something you know worth. An accountant, a tax accountant, can come in and value your business just based on discounted cash flow and come to a number. And that's great, and that's probably the starting point for most folks. What accountants aren't going to see, per se, is, if you've got, again, a key contract that's worth a lot of money, if you've got a trademark or just your name itself, and that may not be spinning off the same amount of cash that's reflected in your financial statements as it's actually worth. So looking at your financial statements is one gauge of what you can expect to get from a buyer, but it's certainly not the end-all, be-all of it. There may be goodwill there that's not reflected on your balance sheet. So, but a great question, and one I will often answer. One of the last things I'll say is the process itself takes a lot of time. You should prepare to spend a lot of time on it. The worst thing that can happen to you, and again, I know, small businesses, particularly the owners of small businesses, typically wear a lot of hats. They're pulled in 100 different directions every single day. These are the folks that I work with all the time. I understand how this works. Consider this a second full-time job while you're going through it. There'll be some days when I will be on the phone with you for 4 or 5 hours, or in a conference room with you for 4 or 5 hours. I understand your business doesn't stop while this process goes on, and I'm sure you're not going to, you're certainly going to feel that. You'll be stressed. It'll take a considerable amount of time, which is why you need help within the company itself. But the worst thing in the world for a deal is to get slowed down, because some buyers, potential buyers that are out there, won't have the patience for it. They're going to want decisions made quickly, and they're going to want to move on quickly. So if you're not ready to do a deal, they're going to sense that, and they're going to move on to somebody else. So the worst thing in the world you want to do is miss an opportunity for a good buyer if you get too busy with other things. So you might need to put in 18-hour days. Not that you're not already doing that. I'm sure some of you are, but you have to understand this takes a lot of time and a lot of your attention. One of the other sort of categories I have here is confidentiality, which is a huge, huge issue for small companies. I sort of break this down into two pieces of this: the inside the company confidentiality and the outside of the company confidentiality. In each case, they're both important. Initially, the inside the company confidentiality, we're talking about your people. So most of the time when owners go through a sale of their business, they don't want their employee base to know that this is coming far in advance, because folks get concerned about their jobs. What are we going to do? Are we going to get laid off with a new owner in here? And that creates a lot of stress. And in advance of a sale, that's never a good thing. A buyer walking into a topsy-turvy employee base will oftentimes get nervous themselves, particularly if it involves key employees. If you've got key salesmen, for example, that are leaving the company because they're fearful of their jobs. That's always a red flag for a buyer. So you want to make sure the people that you're dealing with, or people that are helping you with this process, remain tight-lipped. You need to make sure you can trust them. They should all be signing confidentiality agreements with the company itself, so that they're not disclosing any confidential information, certainly not outside the company, but also within the company. The last thing you want to do is to have people talking around the water cooler about this. Again, it creates unrest, which is not good for you, and it's certainly not good for a buyer walking in to that situation. So
it sounds like a little bit of a tightrope, though. You want to keep it quiet as long as you can without anyone knowing, and then you ultimately, closer to the event, want to possibly get people to sign contracts who are your key people and that you can trust. It's a balancing act.
It is a balancing act, and those key people that you're dealing with will understand the rationale for this, which is why I say you probably want to wrap them up a couple of years before the deal time goes on. So if let's say you're going to try to sell your company in 2019, this is the time to start dealing with those folks, telling them, this is what I plan to do. You're a key cog in that process, and here's why I need you to be quiet. Sometimes you'll see folks, if I know I'm going to be selling to a strategic buyer, and I might know, for example, that my CFO is not going to be wanted there, at least on a long-term basis, the sale process, I might give him a pretty lucrative short-term employment contract with what they call a stay-on bonus, so that if he stays on through the sale, he gets, whatever, $10,000 or more from the proceeds of that sale would be paid to him, so that he knows that he's in this for the long haul with you. You guys are locked arms, and it's good for him, but it's also good for you. Now, on the outside the company piece, this is critical, of course, because you're going to be sharing confidential information of your company, and also, they may be sharing that information with their advisors, their accountants, their attorneys, and so forth. So your agreement prepared and signed before you even really started talking to these folks. Many are what they call a business broker or an investment banker for a larger deal, and those where you typically a standard agreement, and those standard agreements will typically restrict what they call a counterparty, the other party to the agreement, information. Most typically, there's two areas covered in those, is that they can't compete against you with that confidential information. So if they can't then again turn around and use that in their business model going forward. The other key thing is your employee base. You don't want this from you. And a little story I can share with you along these lines. This is critical for. That's really a big thing. It's also a big thing that he knows that the information that he's buying is not on every desk in town, and it's going to become public information in a couple of weeks. They want to make sure that these agreements are in place with anyone that you're talking with. On the employee side, I've just had
could I ask a quick question from one of our lists? Impossible for a seller to maintain confidentiality if they have not brought a broker into the act as a screening agent?
It's very difficult. I wouldn't say it's impossible, but it is very difficult. That's one of the benefits of using a broker, is that your employees aren't seeing what they call suits walking in, and everyone's getting nervous. They either think the FBI is in here looking at things, Uncle Ray's selling the business. So yeah, one of those.
I wanted to say just one more thing quickly. A lot of our members are very small, and so do they need to do that, or is there some other way they should go about it if they have, say, 5, 10 employees, the smaller folks?
Mm-hmm. Well, again, the smaller the business, obviously the smaller the dollars that you have to expend on the sale. You have all the same issues, whether this is $1 million sale or which is one I closed 2 weeks ago, a $40,000 sale. You have all the same issues, but you do struggle with how to allocate those. Would a business broker even take a sale? Probably, yeah, they probably would. Can they scale that back? Certainly they'd have to if they took that engagement with them. Oftentimes, business brokers like to work off percentage fee based on the percentage of the purchase price. But if they know the purchase price here is going to be limited because of the asset base or whatever, there are occasions when they'll stray from that and do it on an hourly basis and give you good advice as well. There are a number of good business brokers in this area that you can tap into. Some are good in some spaces, and others are good in others. So I'd encourage you to have that conversation if you're thinking about this again well in advance. And they'll tell you, most business brokers will tell you right up front whether this is an area that they work with, that these are potential buyers, for example, that they've dealt with a lot of folks in this space, and they become specialized, just like attorneys do. But great questions. Next couple, I'm going to really go through the process itself. There's using what's called a term sheet or a letter of intent to just sort of get all the major deal terms on a piece of paper, so they call it a term sheet. Sometimes this is called a memorandum of understanding. Sometimes it's called a letter of intent. It goes by a lot of different names, but it basically it puts all the basic deal points together: purchase price, whether there's going to be is it going to be a cash deal, is it going to be financed? Those sorts of things will be discussed in that term sheet. Oftentimes, attorneys aren't even involved in that. People working through that, which can be good and it could be bad. There are some sort of potential landmines when you go down that road. Although they're typically non-binding, courts can at times enforce them as binding, because there is what they call a duty of good faith. When you sign one of these, there's a duty of good faith that you'll negotiate terms that are consistent with those deal terms in the final deal. So I caution you on not getting your attorney involved at that point. But again, probably in the deals that I work, I would say it's probably 50-50. Half of them I really don't get involved with until this is signed. I'll get an email from the client saying, hey, we signed this term sheet. Let's move forward. So the next stage after that is typically our due diligence period. And this is buying entity will come in and start sort of shaking the leaves and see what they're buying. And they'll know what the obstacles will be. Sometimes they'll have a structure already laid out in their term sheet, so it'll be either an asset deal or a stock deal, and they'll try to pursue it on the due diligence that is along those lines. So generally speaking, when you're selling your company, you want to sell the equity of the company, because generally speaking, that's going to give you a better result tax-wise. And that's not always the case, but it often is the case. And that's sort of the mentality that owners have, is I want to sell, in this case, the stock, if we're talking about a corporation. So I want to sell the stock of the company to somebody else, so they just take over ABC company. Buyers, on the other hand, don't generally like to do that. They like to come in and buy your assets because they're fearful of your liabilities, liabilities that may be on your balance sheet, but also the ones that are not on your balance sheet, the contingent claims that might be out there. So,
may I throw in another question here before you move on to some of the tax and financial considerations? Someone has asked whether, and I think this would be the case with any professional relationship, can a broker be held liable for information they acquire about the businesses they represent?
they can be held liable. I guess that's what they do with that information. That's probably a loaded question, and one that maybe somebody wants to give me a call about
Okay.
after this is over. But certainly, certainly there are agreements between the selling entity and the broker, and whatever is laid out in that agreement regarding, information and use of information would have to be referenced to really answer that question. As far as structure goes, again, I was talking about the basic, an asset sale versus an equity sale. There are significant differences between the two from a buy side. If you're buying assets versus buying stock, buyers like to buy the assets because they can write them up for tax purposes and then depreciate or amortize them, as the case may be, over their useful lives. And under the tax regulations, they can vary between immediate write-offs to 15 years for goodwill, and if you're buying real estate, up to 39 years. So the write-off is significant. If they're coming in and just buying the equity, there's really no change in how they're depreciating or amortizing any assets that are on the balance sheet. The purchase money that they're putting in at the equity level, typically, and I'm talking about really corporation purchases here, stock, that money really isn't amortized or depreciated immediately. It's really just sitting in there as their basis in their stock. And whenever they liquidate their stock, they, of course, utilize that for tax purposes. But going forward, that's why when folks come in and when they're deciding whether they want to do an asset deal versus a stock deal, most buyers will say, well, for tax reasons, I want to do an asset deal. Of course, the purchase price will be different. If someone's going to be selling their business and they say, well, I only want to sell equity, I don't want to sell assets, any sophisticated buyer is going to come in and say, well, I'll pay you this much for your stock, but I'll pay you this much for your assets, and that could be significant. So when you're selling your company, you really should have an understanding of that. You should also be working with your accountant to sort of model that out for you, because really ultimately what you're trying to do is get a bottom line that's beneficial to you. And if you go into a sale saying I'm only going to sell equity, there's no way I'm going to entertain an asset sale, you may be surprised if someone comes to you and says, well, I'll give you a delta of X dollars, and see what that does to you. It may be significant. And some buyers just won't buy equity. They're just too afraid of the liabilities to do that, and that will be buyer specific, but it'll also be business specific. How much due diligence they want to do, how much due diligence they can do on you to get comfortable with you. Certainly, if you're selling to an insider, someone that's in the company already, say you're selling to your CFO, they're going to be really familiar with the company, how it's set up, all the skeletons that are maybe in the closet. So it'll be a lot easier to do an equity sale.
So do some people, is it possible to, and do they choose then to change their corporate structure from a corporation to a pass-through to make a change?
Yeah, there are situations where that could happen. Most of the time when you go from what I call a C corporation, which I was going to talk about that next.
Oh, no problem.
But C corporations are business corporations that haven't elected to be a pass-through entity. The pass-through entity is what they call an S corporation, which really just stands for the subchapter of the Internal Revenue Code that the provisions fall under. C corporations are tax-paying entities, so when they sell their assets, there is a transaction there that's taxed. There could be gain, there could be loss on that transaction, and that entity itself pays the tax hopefully with the funds that were paid for the sale. It doesn't affect the owners at all at that point. But let's just say, for example, I've got a C corporation that's going to sell its assets for $100. That $100 is paid to the C corp. Then the C corp has to pay taxes on the gain from that sale, and the gain calculation would be the $100 coming in less whatever basis it had in their assets. And let's say the basis was, say, $50. That would leave a gain of $50 that would be taxed at the C corp level. So the C corp would have $100 that came in. They would have to pay tax at that level as well, and use that $100 to pay that tax. The differential, whatever is left from the $100 after paying the taxes, if the company was going to liquidate, would then come out to the shareholders. And there again, there's another layer of tax at the shareholder level when those proceeds come out. So there's really a two-layer tax problem with C corporations, which is why many companies decide to operate as S corporations. With S corporations, there is no corporate level tax on sales. So the owners of the S corporation pay the tax itself, so you don't have this double layer of tax problem. It's just one layer of tax. That same pass-through scenario works with what they call limited liability companies or tax partnerships. There's no entity level tax per se, typically anyway. There are exceptions, of course, to every rule, but for the most part, the individuals are paying the tax as it flows out. So when you're looking at, well, how am I structured? Am I a C corporation? Should I be electing S before this sale? That's something you want to consider with your accountant, with your attorney, well before you go to sell your company. There is what they call built-in gain period before you sell. If there's a sale of your assets after you elect S corp status, you will be taxed on that at the S corporation level as if you were a C corporation. So the IRS doesn't like you to do this right before you sell. There's a 5-year waiting period before you have to do this. If you are able to wait that out, then you should be okay. By the way, that waiting period has changed up and down over the last few years significantly. So you may be in a 10-year waiting period right now. It just depends on when you made the S election itself.
That's good information. Thanks.
You bet. You bet. I'm going to jump ahead because I see I'm being very long-winded here. I apologize. I'm going to go up to a situation.
Well, I was going to want to go a little longer. It's probably okay as long as I let everyone the slides in the recording and posting it on our webpage. If you do have to hang up, it probably won't get up there till tomorrow, nfib.com/Pennsylvania. Okay, go ahead, Tim.
Okay, great. So one situation which I've run into a few times in the last, say, 10, oops, pardon me, that was my timer.
Sorry, go ahead.
I've run into situations where I'm representing that is in a situation where they don't want to be faced with this double tax that I just mentioned before, where the C corp pays them at liquidation of that company. And about 15 years ago now, there was a that was working for a company called Martin's Ice Cream, and that accountant was wrestled with the same situation that I was wrestled with, a C corporation that was going to be selling its assets. And it had a situation where it had a shareholder that had no employment agreement, with the company that it was employed by, no non-compete agreement in place, and also had what we call personal goodwill. It was customer relationships. The key employee of that company had relationships with all the key customers. And that situation was somewhat unique in that most of the time when you think about goodwill, you think about that being a company asset. You know, the goodwill of the company is typically, you know, it's intellectual property, it's workforce in place, it's patent rights, it's trademarks, it's the name itself. Well, in this case, the company certainly had that goodwill, had name recognition and so forth, but it also had, you know, this salesman who just happened to be the key shareholder that had all these key relationships. And when you looked at this person sort of objectively and you said, well, if that person left the employment of the company today and went to work for a competitor or started his own business somewhere else, the company object to that. You know, would they be able to say, hey, wait a minute, you're taking something that the company owns and using it all the time when you're dealing with, or oftentimes when you're dealing with employees that have key relationships with customer confidentiality agreement in place with them. And even then, it's difficult to enforce that in certain. What Martin's Ice Cream, what they argued was, well, we're going to sell the goodwill of the company, but we're also key shareholder, sell his goodwill, his customer relationships to this buyer. So that's what they did. And really what they did is just, I don't remember all the numbers in that case, but let's just say, for example, if the sale of the entire company was for $1 million, they may have said, well, the goodwill portion of the shareholder's piece of that, the personal goodwill attributed to the shareholder, might have been worth $200 or $200,000 of that $1 million. So that purchase price, that part of the purchase price, was actually paid directly to the shareholder. So what that did, if you sort of follow the money, as they say, instead of having $1 million go into that C corporation and then having the gain calculated there, you only had $800,000 going into the C corporation. The other $200 went to the personal shareholder, and he paid tax on that at his level, but it was only one level of tax. So that was sort of a way of escaping the double layer of tax on a portion of the purchase price. And I've seen this a couple of times in my practice since. It works extremely well with accounting firms. There's been actually court cases on this. I've used it with a funeral home. I've also used it with a technology company as well, where there's a lot of intellectual property tied up in one of the owner's heads, which had never been contributed into the company, even though the company was, in fact, using some of that. So it is possible. It's sort of a diamond in the rough. It does require advanced planning. You can't show up on the day of closing and just restructure this so that a payment comes out to the shareholder rather than coming into the company. You really need to set a good track record for this. Again, advanced planning is needed to do this. And you want to have, again, if you're going to do a letter of intent or a term sheet, this should all be laid out in that. It should be very clear in the agreement what's happening. I've been through an audit on this. This is exactly what they look for. The IRS will look for this, and they'll look for, how, was this something that was looked at the 11th hour, or was this, in fact, what's going on? Was the buyer comfortable with this structure as well? So it's something that it's out there. It's a way to avoid some taxation if you are a C corporation and you have these set of facts. I would say, if you possibly do have these facts, get with your attorney and see if these work. There's a number of court cases out there on this. The most famous one is this Martin's ice cream case as well. So that is really the high points that I wanted to go over with you. I'm sorry I went a little long. I covered, I think, most of the things I wanted to hit with. There's always some surprises when you go through a sale process. If you're a seller, say the big thing you want to make sure you do is to make sure you have the time to do it, and you have good, competent professionals helping you on the tax side as well as on the legal side, because you're going to have these issues as they pop up, whether it's up front with the structuring or as the deal changes that may occur during the process. You want to be able to be nimble, be able to react to them quickly. Again, you don't want to miss the opportunity for a good buyer to walk away, because you may not get another one. There are certainly there's a lot of money walking around out there for buys right now. There's people looking to buy companies, but you just never know. You want to make sure you're getting the best one possible, and whether you use a business broker or try to go it alone through your attorney or accountant, there are decisions to be made there as well. Certainly cost.
I have one last. Oh, sorry. Go ahead.
No, I was saying certainly cost is a factor in that needs to be flushed out. But I think whether you go one way or the other, I don't think you'd be sorry by having a business broker involved. It certainly adds a lot of structure to the process for you.
And one last question about that. You had said that there's some who are specialized in certain areas. There are some who are very good or well-known. How does one navigate that to find the right person? It's probably known in the industry, but not by someone, perhaps a small business owner.
Well, you have that conversation with either your attorney who's dealt with these folks before, or your certainly what you should do is contact them, have a sit down with them, and get comfortable with them, because they will become your best friend. You'll be talking to them.
And hopefully not your worst enemy. All right, well, listen, Tim, I want to thank you so very much. And if anyone has any further, there is one more question. If you'll bear with me for a moment here, let me open that up and see what it says. Okay, I am a one-owner company valued about $500,000. What major taxes do I need to be aware of, if any? And this is a good question, because quite honestly, this is rather typical of our membership. Most of them are S-corps, but if you could answer that, that would probably help a lot of the people who are still on the line.
So most of the time when you're selling your company, if you're going to sell the assets of the company itself, it will depend on the type of assets that you're selling, what kind of tax you have. You could end up with a capital gain, again, depending on your setup. If you're a C corporation, capital gain versus ordinary income, there's no tax differential. It's simply it's just taxed at your rate, depending on where you're at. The graduated rate, so the higher your income is, the higher the rate you'll pay. But if you've got assets that have been depreciated and you're a pass-through entity, for example, you could have what they call depreciation recapture, which is taxed at ordinary income rates, which is a higher income rate than your capital gains rate. But ordinarily, you're looking at really capital gains, ordinary income on your depreciation recapture are the big things that sellers are faced with. Thankfully, Pennsylvania just outlawed or phased out its capital stock tax, which at times could get people as well as they were exiting their companies. But that is no longer the case in PA. We no longer have a capital stock tax, which is welcomed by I think all corporation owners. So think that answered the question, Suzanne.
Right, mostly capital gains and income. Okay, well listen, thank you so very much, and if anyone would like to email either Tim or myself, we'll be happy to get you your answers, and as I said, I will be posting this on nfib.com/Pennsylvania by tomorrow. Tim, thanks so much, and thank you all for joining us, and I believe you all have my email because I sent you the request about the webinar. If you have any questions, you can just reply to that. Thank you. Have a great day, Tim, and we appreciate it.
Yeah, thank you. My pleasure.